Hello and welcome to this Money Control live stream. You're watching Opening Bell with me, Nandita Khemka. Well, thank God it's Friday. It's been a fairly long week, but a good one for the equity markets. In fact, we are looking for another weekly win, barring Monday. All of the other days, we saw gains. In fact, the Nifty clocked in that 25,400 mark on the upside, and 25,500. Well, all of us would want to see, that level also coming back on the charts, and we would want to go home over the weekend with that level, so to say. But GIFT Nifty this morning is hinting at a fairly muted start. Let's see we can whether we can defy those cues and end around that 25,500 mark or so. But let's see. Yes, busy day on the anvil for the market as well. You have Adani Group stocks that have been in focus after the SEBI has given clean chit to the Adani Group firms in the Hindenburg case. That's a big relief coming in. In fact, we have a couple of brokerage notes as well. Morgan Stanley has initiated coverage on Adani Power. Of course, sees a fair bit of upside on the stock, and of course, analysts believe that this marks the lifting of an overhang from the Adani Group of stocks. So yes, lots in focus. All your stock related queries will also be in focus. Keep them coming in. We'll try and get them addressed by our experts on the show. But for now, in the pre-open, we are seeing green ticks on the charts for the Nifty. Let's hope we start the day on a positive note, defying cues from the GIFT Nifty. But before moving any further, quickly take a look at the top stories at this hour. Wall Street ended at record highs a day after Fed cut interest rates by 25 basis points. Nasdaq surges over 200 points. Stock futures as well remain steady after market rallies to all-time highs. Asian markets are mixed as investors await Bank of Japan's policy decision. The GIFT Nifty was lower, but in the pre-open, we can see some green ticks on the charts. Crude prices settle lower as traders assess US stockpile data and the Federal Reserve's rate cut. Meanwhile, gold takes a breather as markets weigh Fed's policy stance. SEBI clears Adani Group firms, Adani Ports and SEZ, Adani Power and Adani Enterprise of all Hindenburg allegations. The market regulator finds no evidence of insider trading, market manipulation or shareholding violations under the SEBI Act. And US President Trump is expected to dial Chinese President Xi Jinping later today to finalize a deal on short video platform app TikTok. All right, then those were the top stories at this hour. But quickly, get you a recap of what really transpired in yesterday's session. It was a volatile session. There's no taking away from that fact, given the fact that it was Sensex expiry yesterday. So we clocked in the 25,400 mark. We came close to 25,450 or thereabouts. But there was a fair bit of profiting around the middle part of the day. In fact, we switched or slipped below the 25,400 mark. We were around the 25,350 mark. We kind of cooled off from the day's high. But last hour, once again we saw bulls picking up steam. And we managed to close above that 25,400 mark. So now the market has risen to the highest level since early July. In fact, IT and pharma, these were the top sectoral movers, reacting to the Fed rate cut of 25 basis points. That was the first of 2025. Broader markets were also moving in line with the benchmarks. In fact, the Nifty Bank Index, 12th straight day of gains, 55,700 was cleared on the upside. 55,600 was an important technical level on the Nifty Bank Index, but it managed to shut shop and rise above that 55,700 mark. So that end or that engine of the market has also started participating. Earlier there were concerns that Nifty Bank was not really firing up, but those concerns have also been laid to rest. A lot of movers yesterday. Glenmark Pharma, insurance stocks were also moving higher. IT pack was also upbeat on the back of the Fed rate cut. Poonawalla FinCorp, that deserves mention, surged 13% as promoters infused capital in the company. HFCL was the other one that moved higher after it came out of the F&O ban. And IRM Energy, that stock was once again in focus. It has been on a gaining streak. The stock is up 34% in a matter of 4 sessions. In terms of the F&O Qs, the put call ratio dropped to 1.16 vis-a-vis 1.21 in the previous session. Talking about the stocks in the F&O ban, HFCL was out of ban yesterday, saw good traction, but today once again it's back in the futures and options ban. Still in ban are the likes of Angel One and RBL Bank. Watch out for RBL Bank. Perhaps it could come out of the F&O ban today, but Oracle Finance, that stock managed to exit the F&O ban list yesterday. In terms of fund flows, well, we had a buy figure from FIIs once again. This is the second time in the week when we are seeing buy figures from FIIs coming in, but that's meager, so to say. 366 crore worth of stocks bought in the cash markets, but still one would take heart from the fact that we were in the green when it comes to foreign inflows. DII buying support continues, 3,300 crore worth of stocks bought in the cash market. And of course, that's about how things really shaped up yesterday. Today, of course, as I was mentioning, Adani group of stocks will be in focus. The market regulator, SEBI, has cleared billionaire Gautam Adani and his diversified conglomerate of allegations related to stock manipulation made by US-based short seller Hindenburg Research. Now, SEBI's investigation found no evidence that the diversified group used related parties to channel funds into its listed companies. Now, in two detailed orders, SEBI concluded that claims of insider trading, market manipulation and breaches of public shareholding norms were unsubstantiated following an extensive investigation. But of course, Adani Power, keep that in focus, given the fact that Morgan Stanley has initiated coverage on the stock, projecting an upside of 29% from yesterday's close. Of course, it has initiated coverage with an overweight rating and a price target of 818 per share. Of course, the stock ended around the 6,633 mark in yesterday's session. Of course, the brokerage says that Adani Power is a good illustration of a turnaround in India's corporate history, with resolution on most regulatory issues and multiple value accretive acquisitions as well. But on that note, let's bring on board our guest for today. Joining me is Raja Venkatraman of NeoTrader. Raja, lovely chatting with you on a Friday morning. Of course, it's been a good week. Good gains coming in, barring Monday. We've seen the Nifty, edging higher above that 25,400 mark. Where do we head from here, and buy on dips? Should that strategy continue from here on?
Yeah, good morning, Nandita. Thank you for inviting me to the show. And like always, we have been speaking about one thing for sure over the last few weeks is that do not go short, stay on the long side. And yes, we were rewarded in the last few days, and the move, though was quite swift, it did give a sense of relief to the bullish camp. But then now what we have to contend with is that the overall move which we are seeing right now is amidst a lot of geopolitical tensions out there. So the up move, yes, it's going to be a more measured one, and it's not going to be a runaway rally, right? If you now see the technical setup, everything is firing. You are seeing the mid and small cap firing, you are seeing the large caps firing. But then we really have to take this rally with a pinch of salt. Yes, the move has been quite strong, and I believe that the move should sustain. But then I do believe that continuous buying of the indices at the current juncture would not be appropriate moment. But yes, a dip by rally, like you mentioned, is the way to go ahead. Dip buy should be initiated, and the dip levels would be closer to the maximum region, which is emerging closer to the 25,350 mark. So any dip in the 25,350 is the first level of support. 25,250 is the next level of support. I think that that should hold on and keep the market moving higher. Now, the main contributor to this rise, like we had discussed last week, was Bank Nifty. So there was a lot of emphasis on Bank Nifty to perform, and yes, Bank Nifty did make up for its lack of participation, and it has come out very strongly. I continue to believe that this move in bank should sustain, and it should. This move in Bank Nifty will percolate amongst all the associated sectors like auto, real estate, and the NBFC. So those are the other sectors which one should watch out for. And we cannot forget the IT sector, because beneficiary of the rate cut, there was already some move which had been factored in ahead of the rate cut of Fed. And now I see that the continued promise which is emerging from the global overviews. Like it can either be Trump or it can either be the China, Putin. But everywhere you see around, you are only looking at the global sentiment for dictating the domestic trends. So I think that's the way it's going to be till we come out with the results. That's in the next month. But for this series, it's going to be more of a global news flow.
Point taken. Global news flow. By the way, the Bank Nifty was in fact up for a 12 straight session yesterday. That engine of the market has started firing. Although over the last 12 days it has staged an up move, but the rise has been fairly tempered. So only recently it has kind of started gaining traction. But talk about the Adani group of stocks. A major regulatory overhang lifted. The clouds have lifted, and in the pre-open we can see Adani group of stocks dominating the gainers list. Adani Enterprises, Adani Ports, and Adani Power. Anything that you will be keeping on your radar for today in particular, because Adani Power, there's already a brokerage note. Morgan Stanley sees a 29% upside. 818. That's the target price from Morgan Stanley. But what are your thoughts among the three? Which one would you prefer, and any targets to watch out for?
Yeah, so from the kind of news flows which we are having in the Adani group, it's been one of the most volatile counters, I would say, in the entire group related stocks, I would say. So now this particular news flow of SEBI giving a clean chit, yes, it is definitely augurs well for the stock. But then I would tread my path carefully in this group. And if I were to choose any particular counter, then it would be Adani Power. The sector is heavily supported by the government. B, it's planning to invest $6 billion from the into the power, and the also the JP Power news also coming in play. So that's what is getting the brokerage re-rating as well. So when you combine all these inputs and the price action, which yes, it's a slow measured move. So those who are looking to participate in Adani Power, then that is the place to be. So yes, Adani Power is very encouraging, and I would say that targets closer towards 800 is looking possible. And if we were to invest into the Adani group, then normally people look for, say, maybe Adani Ports or Adani Enterprise and or Adani Green as well. So that's also having some positive news flow today. But then I would say that Adani Power is a much better bet, and the targets of 800 to 850 is possible within the next 6 months.
Okay, 800, 850 possible within the next 6 months on Adani Power. That's the chart that's looking most attractive amongst all the three. We had a query on an Adani group stock on our feed. Adani Ports as well. Any targets that you'd be looking out for there, because we have a query coming in from Naveen on this counter.
Yeah, Adani Ports has shown some uptick, and I would say that we got to take it slow here, because again it's going to encounter some headwinds out here. So I feel that immediate targets would be closer to the region of 1500. But then if you're looking at it from say a multi-month investment perspective, then you can target 1750 to 1850 within the next 6 months.
Okay, those are the targets to watch out for on Adani Ports. Hope that answers your query. But let's shift focus to some other stocks. We have two more. Actually, we have 2 minutes to go for the markets to open. Raja, why don't you share your recommendations for the day for viewers?
Yeah, sure. So yes, one of my stock recommendation is from the new age segment, and I would like to go with a buy in Nika at current levels. Have a stop loss at 232 for a target towards 248. And the second counter would be from the pharma space. Yesterday, we saw quite a lot of pharma stocks picking up, and they were quite subdued. So from there, I find that Dr. Reddy is showing some good spirit here. So I would like to go with a long in Dr. Reddy at current levels, a stop at 1298 for a target towards 1355.
Okay, those are the stocks, Dr. Reddy's and Nika. But quickly before the market opened, any thoughts on Reliance Industries? The stock has picked up a good steam in the last 2 weeks. In fact, month to date, the stock is up almost 5%. It's at a crucial juncture. Technically, 14 is where it's at. Immediate targets to watch out for here?
Yeah, Reliance has not been. Yes, it has showing. It is showing some revival right now. But then I continue to believe that it can continue its range-bound fashion until it clears levels of around 1550. So yes, if you are immediate, maybe a month or two outlook, then you can look at 1550 as a target. But then I would say that if you are looking at it from an investment perspective, wait for the hurdles around 1550 to clear, because that's when then they start the
Hmm.
overall price momentum will gain more traction. And then if you're having capital, then this is a good point to enter and add more above 1550.
Hmm. Got it. 1550 would be a crucial level to watch out for on Reliance Industries. But with that, the first ticks are coming in. It's a fairly muted, softish start, but nothing really to complain about, because this week has been pretty good for the market. Barring Monday, we've seen the markets gaining for each and every session. And prior to that as well, we had clocked in 8-day winning streak. So nothing really to complain about. Bulls are, you can say that they are cooling their heels a bit, catching up a bit, catching their breath a bit. It's just about a 20-point cut on the index, 25,400. That holds for now. We are around about that level. The Sensex is down 150 odd points, 140 odd points or so. 82,885 is where it's at. The mid cap index is managing to hold its head above the water. It's up 0.2% right now as we speak, and the breadth is also looking in favor of gainers at the current juncture. 1378 advances to 729 declines on the NSE. So, in a softish start, but nothing really to worry about. Global cues are also mixed, fairly muted, although Wall Street, of course, hit a fresh record high. Some bit of a pause here. Let's see what the sectors are doing. Yesterday, of course, we saw pharma and IT taking the lead. PSUs, although, took a pause as well yesterday after 2 days of good run. But today, let's see, what's taking the lead. It's the metal pack that's up 0.4%. That's taking the lead when it comes to the sectoral movers. FMCG is in the green. FMCG, mind you, has been witnessing some bit of profit taking off late. IT extending gains up 0.2%. Pharma as well is extending its gains up 0.3%. PSU banks trading marginally in the green. Real estate also marginally in the green. Mixed picture, so to say, because autos are on the back foot today, down 0.2%. So all in all, sectoral picture is mixed. Metals among the top gainers, although dollar index gained some traction last night. It's above that 97 handle, but still metals are still edging higher. In terms of the individual movers, let's see what the Adani group stocks are doing. Yes, Adani Enterprises up 5%, Adani Ports up 2.5%. Want to see what Adani Power is really doing right now, because there's a bullish note as well, plus even Raja is bullish on the counter. Yes, 8% higher on Adani Power. It's at 682 at the current juncture. Aside of the Adani group of stocks, what's doing well are the likes of Shriram Finance, Hero MotoCorp. Life insurers were in a spot of bother, but yesterday they staged a good comeback, and today as well, HDFC Life is edging higher. Geo Financial is up and about. IndusInd Bank, Maruti, Eicher, some of these auto names, although the index is lower, but some of these auto names are doing well. HUL, Cipla, Asian Paints are some of the other counters that are among the gainers. In terms of laggards, M&M is the top laggard. Eternal, after hitting a fresh 52-week high yesterday, has come under some bit of profit taking. It's down 1% or so, but for the week, the stock is up 4.5%. Bajaj Auto also under pressure. ICICI Bank, Grasim, Tata Consumer, barring that one day when it saw 4% uptick, the stock has seen selling pressure. Titan, TCS also in the red, and so are the likes of Nestle and Trent. But talk about Tata Consumer, Raja, just one day we saw 4% up move. The stock has actually not really participated in the upward move that some of these FMCG names saw. What are the charts hinting? Is the structure looking weak, sideways? How would you look at the charts?
Yeah, see, when you take a look at the FMCG counters, they tend to move in bursts. And what I found is that especially this counter of Tata Consumer, it has not been able to generate that much of an up move. And majority of the times, its up move is quite labored. So now what has really happened is that after the initial run which we saw post the GST calibration, we are not seeing much move in the FMCG space as well. And amongst them, Tata Consumer seems to be drifting sideways. So I would continue to believe that yes, the bullish drift is emerging here, but then it is mostly from a say a 6 month perspective if you're willing to hold on. But if you're looking to it from a say an intraday or a daily perspective, then I don't think much traction is emerging because the momentum is building slowly. So when the momentum is building slowly, we also got to taper our expectations, and yes, it is come out of its shadows. And I would see a targets to closer towards 1200 to 1250 within the next 6 months.
Okay, 1200, 1250 within the next 6 months. Yeah, as you rightly pointed out, FMCG stocks tend to move in bursts, and that's what happened with Tata Consumer as well. One fine day before, I think the stock was the top Nifty gainer up 4% or thereabouts, but then ever since then, it has once again slipped into the red. But let's shift focus to another counter, Unichem Labs. It has got a 19.5 million euro demand notice from European Commission in a patent dispute case. The stock, I think, hit a fresh 52-week low in today's session as well. It has been in a downtrend. If you look at the slightly longer term charts as well, like 6 months, YTD, stock has really been under pressure. It has been beaten down, so to say. Would you look for more downside here, or has it reached a bottom? What are the charts saying?
Yeah, you're right that it has been on a decline over the last couple of weeks, not even days, a couple of weeks. So the trend clearly is pressure to the way down, and right now, especially over the last few months, I would say that tailwind in any stock is very critical. Now, in this stock is facing headwind, so it's going to pressure the stock to the downside. So yes, it is definitely a call for exit from your current position, and it looks like it is slowly building up for more correction out here. So I would not be a buyer in this. If I have position, I will choose to exit this counter intermediate.
Okay, choose to exit at this point. Let's take up some viewer queries then, quite a few of them. I spotted a query on Poonawalla FinCorp, and I want to take it up because the stock, really shot up like a, bazooka, so to say, in yesterday's session. We have a query from Satya CK. Wants to know what should be done. Is it time to book profits? I think he holds the stock for the last 1 year, and he had bought it at 350. Good profits here, but should he hold on? Is there a fresh breakout? How would you or what would you advise him to do?
Yeah, so yes, he has bought it at a good price, and what it's doing now is it's actually going to cross the 2024 highs, so which is a very good signature of a continued up move. And in the last week, we were discussing just few minutes ago in the show as well, that the NBFC stocks are going to now show some movement, and this stock is definitely poised for more upside here. So one should continue to hold on because. There is no call for any exit here. I see fresh momentum building here. So it's a good stock to hold on.
All right, a good stock to hold on. That's the advice. Hope that answers your query. A couple of queries on banking names, the PSU banking names in particular, the likes of SBI and Bank of Baroda. Komal Makecha wants to know whether it's a good time to enter into SBI for the long term. And we have a query on Bank of Baroda coming in from Satvika Ranganathan. Wants to know your thoughts, on the long-term targets of 1 year or so. Advice here because PSU banks have been witnessing good traction.
Yeah, you're absolutely right. Like Bank Nifty started picking up, and all the weights in the Bank Nifty started moving. And PSU banks especially have not shown much of move almost for the last, I would say, 6 months. And today, after this bullish wave which we are experiencing across the market and also across Bank Nifty, that has really brought the limelight once again back into the PSU banking space. And SBI is leading from the front. I would say SBI is a better bet, and I would say it could flash a new high within the next 6 months. So one should continue to hold on. Also, can also look to add here because it has issued a fresh breakout above 830, and that augurs well for the prices.
All right, SBI a better bet, but hope that answers your queries. By the way, I was just looking at the Nifty 500 gainers. The top 6 gainers, all Adani Group stocks, buzzing and how. Adani Total Gas up 10%, Adani Power, as I mentioned at the start, up 7-8%, Enterprises up almost 5%, Adani Energy up 4%, and Adani Green also up somewhere around 4%. So, yes, regulatory overhang removed, and we can see the reaction on the Adani Group of stocks. Reddington of late has also been buzzing quite a bit. Raja, before I come to more queries, what do you make of the up move here? It's at 300 or so right now. Is there a trade? Should one chase momentum?
Yeah, yeah, especially with the iPhone sales launching today. So it is generating the strong up move here. And yeah, trading right now is quite difficult. Trading right now is quite difficult because the market has, already delivered its verdict on the iPhone 17. And we can see here that it is challenging its highs around 330 levels. So yes, if you are, if you have bought Reddington instead of the iPhone, you would have made much more money, I feel here, because the kind of move which we are seeing here is quite terrific. So yes, the move is sustaining, and I see that it is flashing a good up move here. So if you want to enter, the levels will be closer towards 275.
Okay, wait for a dip around 275 to really
Yeah.
look at trading into Reddington. But let's focus in on some more queries then, quite a few of them trickling in. I don't want to miss out on any of these queries. Let's take up some queries from new viewers. BU Dipankar wants to know your thoughts on BPCL. He has 1,000 shares which he purchased at 340 or so. At the current juncture, it's at 326. He's making some bit of a loss here. But I think we've seen a steady run when it comes to the likes of BPCL, HPCL, especially in the last 6 months. We've seen a very good uptick. But last month, last 5 days, it has been a steady ride. Should he wait? Should he hold on? Do you see more upside?
Yeah. Yeah, so BPCL, the OMC counters are subjected to the vagaries of the crude oil movement and also the geopolitical news flow. So, what one should consider here is that the move here could be a more slower one, and one can hold on. The overall prospects on the higher time frame looks encouraging. Only thing is that it could face some headwinds closer towards the 360 region. Yes, one should hold on, and if it actually clears 360, it opens new doors for BPCL. So yes, it is definitely a hold for the moment, but then one should, the risk point would come only below 305.
Okay, hold on to it. Risk factor or risk point comes only below 305. Hope that answers your query. The next query is coming in from Shashank. Wants to know your thoughts on Amara Raja. Holds 100 shares at the rate of 977. The stock is at 1033 or so. What should he do here, Raja, for an Amara Raja?
Yeah, the Amara Raja has, after it ventured into the EV theme, is holding on to its decline, which it saw over the last 1.5 years. But right now, the stock is not showing any encouraging signs of revival despite the market, or you would say the mid and small cap showing some up move. Unlike the large cap, the mid and small cap have actually, some select stocks have actually done quite well, and now they are picking up pace. So I would say that if you are going to consider this particular stock, your risk point would be around 945.
That's the view then. Hope that answers your query. Watch out for levels of 945 on the charts of an Amara Raja. Just spotted a query on Bajaj Consumer. Don't really know the person's name who's sent the query. Holds Bajaj Consumer at 222 levels. What should I do? Book profits or wait for more upside? So the stock, has had a very good run. He's in some profits, but last 6 months we've seen a phenomenal 60% up move already on the stock of a Bajaj Consumer. Should he wait for higher targets, book partial profits, or just stick to it?
Yeah, no, not at all. The momentum is very much there, and like you've seen in the last week has been one of the most promising one for Bajaj Consumer, and it looks like it could challenge its highs closer towards the 280 levels. So that is where one should look to book partial profits. And if it moves above that, then it opens new doors towards 325. So I would say that it's a hold.
All right, it's a hold. Last week or so, in the last 5 sessions, the stock has rallied 15% almost. Stick on to it. Don't look at booking profits right away. The next query then, I know we've discussed Amara Raja, but just one query has come in from Anup Rajaguru. He wants to know about Exide. Is it time to enter for short term or buy the September futures? How should he play this stock now? Via futures and options or in the cash market?
Yeah, Excite is always an interesting play and it attracts attention amongst the futures as well as the cash segment. Yes, you could play by the future segment. The move is just begun and it has the immediate targets would be closer towards the 450 mark.
All right, 450 mark. That would be the immediate targets on an Exide. But last query then for the day, I just spotted a query from Payal Kalra. Wants to know your thoughts on Varun Beverages. She's been holding it for almost a year. Uh, if somebody wants to get out of it, is it an opportune time? How should she look at this particular holding?
Yeah, see, this particular holding has not really, shown any kind of movement here. Neither the IPL nor the FMCG news is triggering any kind of
Hmm.
movement in this stock. So, its stock is also going to face headwinds closer towards the 540 region. So, 540 on the upside, 440 on the downside would be a range which I will suggest, and you can take a suitable call based on that. On the lower side 440, on the upside
Of
540. So
course,
that's where you can experience. Yeah.
that's true. Hardly shown any fizz. The stock completely lukewarm, so to say. That's the view on Varun Beverages. Then hope that answers your query. But with that, we've come to the end of the query segment, and of course, we wrap up the technical side of the show as well. Raja, would like to thank you for taking out time and joining in this morning every Friday as usual. And of course, Friday the mood is really upbeat because we are heading into the weekend as well. And this has been a good week for the equity markets as well. But look forward to again interacting with you next Friday, Raja.
Yeah. Thank you. Bye.
Bye. Well, to quickly take a look at the market, we've slipped a little more below that 25,400 mark as we speak. 25,350 on the charts. The Sensex is down around 275 points or so, but the mid cap index is holding out in the green, 0.3% kind of gain coming in on that index. Breadth is also even Stevens, but slightly tilted towards gainers as we speak. But on that note, let me bring on board our next guest for today. Joining me is a big voice, Arvind Chari, Chief Investment Strategist at Q India UK. Joining in, Arvind, lovely chatting with you this Friday morning. Hope you're doing well. Just want to start by asking you your thoughts on how trade or how India is shaping up vis-a-vis developed markets like US that have seen a great run this year, hitting all-time highs, almost regularly. Even the EM basket has done fairly well, much better than India. Look at Chinese markets up 40% in the last 1 year or so. But, India, of course, has seen double-digit or flattish moves. What is your sense? Of late, we have started seeing some traction, some momentum building up. Do you think that will stay? And are we poised to reverse course and start firing up as well?
Thanks for having me. Good to speak to you again. So if you look at very broadly 5-7 year track record, if you've seen, India has been a significant outperformer as compared to China, as compared to emerging markets, and probably India has been among the few countries which has kept returns on pace, or if not exactly on pace with the US, but at least matched it up. But in the last year, that has slipped. I think India is underperforming the emerging markets by about 20 odd percent YTD this year itself. And of course, as you said, the China markets have done even better. I see that as a reflection of two things. One is, of course, flows. You've seen continued net outflows from foreign investors, almost $35 billion if I do for almost a year. September 2024 was when kind of the market was at the peak, and we saw a downfall since then. and maybe it should be about $40 billion since then. So one aspect of that is the nature of flows that India gets. A significant share of flows that come to India in the public equity markets is from global or emerging markets or Asia dedicated funds, and not as much as India dedicated. So if you see from that perspective, given the fact that other emerging markets, Brazil, China, and some other markets have done relatively better, and India was such a high performer and outperformed in for so many years. I think you have clearly seen foreign investors pulling some money away from India because India has done well on a relative basis, and they are kind of booking profits. They are exiting, but they're essentially selling what significant amount of gains that they've had, and using that money to to allocate to other countries which did not perform, or where they think that the momentum is stronger. So that is one way to think about it. The second aspect is the fact that the overall EM allocation from global investors itself has gone down, right? So India is getting a share of that, a large share of the EM allocation, and some of that is being taken away. But overall EM flows itself have been slow till at least 2024, right? Because US and the developed world was doing so much better, there wasn't any major interest from large investors to increase their EM allocations. And a large part of EM was China, and China was hurting and was underperforming. So you could see many more investors were taking money away from EM and putting in DM. So the total pie of money available in the EM allocation itself was a lot lesser over the years. Maybe that is changing now, as after Trump, you've seen some amount of money being pulled away from the US, and maybe the immediate allocation will go back to large home countries, large developed markets like Europe and Japan has, of course, seen some inflows, but eventually it will show up in emerging markets, and maybe the pie of emerging markets will increase, and then India will again start seeing net inflows. The second aspect, of course, is local. Earnings have been extremely disappointing, and we used to make those squiggly line charts, and we show that from 2013-14, where analysts start the year with a higher expectation, and by the end of the year, the actual EPS numbers are lower. And if you keep drawing those squiggly lines for every year, you know that the lines are all downward sloping, barring 2020, 2021, and 22, where analysts were, surprised on the upside, where actually earnings were higher than what they anticipated, and they could increase it. And you could see that trend maybe in 23, 24, or again, you've seen a flattish year last year, and a down year. I mean, it looks like 6% or something like that is consensus earnings growth. So till the time that earnings momentums comes back, the reason that India is always trades at a premium to emerging markets, and it still does, but that premium has come down, is because Indian earnings growth is higher and Indian return ratios are much better. So one aspect is flows, where India has done well. They've taken some money out of India and reallocated to other emerging markets which have done well. The overall pie in the emerging market flows has not increased by much. And the third is, of course, the domestic story, where earnings really have to pick up for valuations to make sense, because the domestic flow has ensured that valuations still remain expensive in many parts of the market.
Expensive. But do you think that the earnings downgrade cycle may have peaked out? Because the FY25, as you mentioned, single digit, FY26 as well, the bar is pretty low. But the chats I've had with a lot of experts, they believe that double digit earnings growth for FY27 can't be ruled out, especially in the wake of a demand boost as a result of the GST rejig. Would you be of the view that FY27 would be the turnaround year?
It could be. Given the fact that what you mentioned. So one has been, I think the government has started looking finally at the consumption income side of the country's balance sheet, if you want to look at it, as compared to focusing on the capex infra aspect. And you've seen some relief on income tax, which happened during the budget, and now you've seen the GST cut as well, which should be a bit more consumer consumption income supportive, and that has been lacking, right? So if you look at consumption growth or income growth, you take any 3-year, 5-year CAGR numbers also, or rolling year numbers, it's been growing at much below GDP as well, which just shows that that segment of the market predominantly impacted by COVID. But even before that, we had some aspects of shocks in the system, had not recovered as well, and that is maybe also one reason why private capex has not picked up. So the private capex story happens predominantly for two reasons. A, when Indian companies are able to see export opportunities and then put capex, and they make the export. And that's what, if you look at the 2003 to 2007 cycle, it initially began with the export boom. The global growth picked up and export opportunities increased, and that's why capex came in. And of course, it was also followed by a domestic boom for the next 5-7 years. And maybe that aspect is missing. So if you see higher consumption growth and higher income growth in across the middle and the lower level of the strata of the society, you will see that we are seeing some aspects of it. Consumer sentiment, although it has flattened in the last 2, 3, 4 months, I'm using the CMI data, but it had started improving quite well and had gone to pre-COVID period sometime last year, and has kind of slightly gone up, but it's flattened out in the last 3, 4 months. And maybe we'll see that as consumer sentiment picks up, you would assume that company revenue and eventually profitability. I think profitability might follow a bit later, because companies will first want to increase revenue, and you're already seeing that most companies have come out and said that they're going to pass on the GST benefits. Most of them actually done complete pass through of the GST cuts. So you will expect some amount of increase, but like if you look at the GDP data itself, nominal growth at 8.5% does not bode well for a double-digit earnings growth. So once that nominal GDP growth increases, some amount of inflation power comes back for people to have some increase in nominal activity. But I would still not bet on a very very high increase. Some sectors, some cyclical aspects may follow. If the US trade deal and the EU trade deal comes, and India is able to capture some of the global momentum that we are seeing, maybe earnings might see a big boost. But otherwise, nominal growth is still at about 9 to 11%. That is the band that nominal GDP has traded, and nominal corporate revenues also have been at around that level. But yeah, better than last year for sure. There is definite momentum and activity, and we know corporate balance sheets have been pristine, and bank balance sheets have, at least bank on the corporate side has been pretty good. Retail loans have not seen reasonably any large spike in NPA levels. So you know that the household balance sheet also is not completely impaired. And if everything comes through and India gets some momentum, then you might see some increase in earnings, definitely higher than what we are seeing here. But whether it will be high double digits, I'm not very sure about that.
Okay, point taken. I just want to ask you, in terms of sectors, do you have any overweights when it comes to the Indian markets? Any pockets that you are overweight on at the current juncture?
So, of course, I do not directly manage the equity portfolio, but if I look at our value, the Q India value equity strategy that we run for Quantum Advisors, and the Quantum Value Fund and Mutual Fund, if you look at that portfolio as a reflection of seeing where do we see stocks which are at a discount to 2-year forward intrinsic value. That's the way we position our portfolios. So we've continued to have a reasonably high weight in financials. That includes banks, private banks, some financials, and the savings side of the economy, insurance, asset management companies. That's remained our high weight purely from a valuation perspective. We still don't think earnings or book values are compounding at a very fast pace, but earnings cyclically or adjusted for long term is attractive. That's our positioning. IT services has remained. We've been able to add. So that is one segment which has not done well, but we are seeing some momentum. That is another way. Consumer discretionary as an entire sector. If I look at what the portfolio position last year, we had trimmed off and taken some positions off. But we have slowly starting to add back into some of those consumer discretionary, consumer durables names as well.
All right, those are the sectors that, of course, quantum is overweight on. But let's talk about the Fed rate cut trajectory, right? Of course,
Yeah,
the cut that was rolled out this time around, first cut of 2025, 25 basis points. It was more of an insurance cut, if I put it in the words of
yeah,
the Fed chairperson. If
correct.
the labor market sees some bit of stability, would you expect it to be a very shallow rate cut cycle? Because there are stagflationary concerns in the US as well that the Fed is grappling with. What are your thoughts on the future trajectory? And how would it impact flows into emerging markets? You see that picking up? As you had mentioned earlier, that of course that pie has been diminishing. But this rate cut,
Yeah.
would it move the needle?
Yeah, I think there's a reason the Fed chairman said it's what a risk management cut or something like that he mentioned, right? And that is because there was expectations that inflation in the US will go up, but it has not shown in actual ground level data. And the expectation was that because people would have front loaded a lot of inventory, would have imported a lot of stuff before the entire tariff imbroglio happened, you're maybe not seeing it, and companies have taken off some of the impact of the cost increases. But eventually that'll get passed through. That's why the dot plot on inflation and the dot plot on employment are all over the place. If you look at the different Fed projections, so that I think that you'll have to wait and see how the inflation impact happens. There is definitely softness in employment, and that's why they've started moving. Despite, I don't think they are very confident about the inflation projections coming down or maybe even inching up. But because the labor market and the labor data is showing softness, and that's why they've already started moving. You're right. It looks like it is going to be 50 to 75 basis points as of now, unless because of the tariffs and the continued uncertainty, investment cycle in the US stops or does not pick up, and that leads to a very sharp fall in growth. But as of now, doesn't seem like, because the way they're positioning the tariff is that a lot of companies will actually reshore back into the US, irrespective of whether they like it or not, whether it's positive for them or not. They'll have to kind of manufacture or source within the US. So if the investment cycle continues, you could see a scenario of what you call a short-term stagflation, where you're seeing higher inflation and lower growth. Uh, but yeah, as of now, the expectation should be that it will be reasonably shallow. If inflation actually picks up, which is what the worry was from the tariff aspects, you would see a lot more impact. And then the worry for the bond market in the US is, of course, fiscal. The big beautiful bill also has been passed. Tariffs will get in some revenues for the US, but it's not going to be very, very significant. Given the fact that even with China, the effective rate is now at 25%. Like, India is 50, China is at 25, 30 till the time they negotiate the trade. So it's not going to be very significant tariff revenue, but there will be some increase. But the worry on the US is the fiscal aspect, right? So that's why bond yields have not
Sure.
they've moved down. But after the Fed hike, it's not been a big. Even the bond markets are not expecting a 100 basis point cut, for example. They're not pricing it right now. From the flow point that you
Sure.
asked, I think, yeah.
Sure. Go ahead.
Yeah, from the flow point that you asked, so if you look at global investors are significantly over invested in the US, purely because US has done so well. Like, it's been a no-brainer to buy the S&P 500 or the Max N or Mac 10 and just ride that curve, and it has done well for the last 10 years. Because US has done relatively well, its share in the MSCI World Index went from like some 40% to closer to 65, 70%. And hence portfolios, both domestic US investors as well as global investors, were over allocated. And after, in the last 6, 7 months, you've seen risk coming out, right? So risk is not always about markets and, market fall and up and down. Risk could be very different for a European investor or Canadian investor or Australian investor investing into the US, right? In terms of how they'll be treated and, capital controls, stuff like that. So you're already seeing some aspect of that, where some European funds, pension funds, have taken money out of the US. And so I think that will continue. It might not be an aspect of, for as a political or a view on US. It could just be that the US has done so well and the future prospects for companies and profitability might not be as attractive, and people might be willing to look at, reallocating. As I said earlier, initially that money will go back to the home country, but eventually you would assume that some amount that money comes back into emerging markets, especially if emerging market growth holds. And I had put out a note back in April that the total amount of money in the investment in the US markets is about 40 trillion. 30 trillion is public markets and about 7, 8, 9 trillion is in the private markets. And even if 10% of that comes out of the US, that's about $4 trillion. And I had just put out a back of the envelope note saying that if India gets 5% of that 4 trillion, that's $200 billion. That is a significant amount of flows that should come to emerging markets and then to India. Of course, India had the skirmish with Pakistan and then the US-India trade deal. So, things have not been very rosy from that picture. When a global investor is saying, okay, I want to come out of the US, where should I go? Should I look at India? India looks attractive. And then you have two episodes of, risk that puts in their mind and in their risk committees discussing that, is it, is something happening? So maybe not the opportune time, but eventually as that money will flow out, from the US, whatever the excess allocated, some amount of money will get into emerging markets, and I think we will see more what we call India dedicated mandates. As I said, 70-80% of the money that we get from foreign investors is global allocations, global emerging market funds or global funds or Asia fund, and not as much as India dedicated mandates. But you will see more money into India dedicated funds. And pensions and sovereign wealth funds and insurance companies will look at India in a dedicated manner. We are seeing some signs of it as I go out and speak. One of the reasons I moved to London was to do that for Quantum, to speak to global investors and get them to think about India in a dedicated manner. Because Indian public equities, if you look at any long-term chart, has been a significant outperformer, and that very clear link between Indian GDP growth and market returns. We've seen those charts. Is very, very strong, and we keep making that case. Looks like, something like that will happen over time, but it's going to take time. So from the EM flow perspective, as of now, it's like a dollar flow. As dollar keeps depreciating, you will see, money flows coming into the emerging markets. But the broader aspect is, will money move in a structural manner, like even if 5-10%, as I said, moves out of the US and comes into emerging markets in India, these are large flows to look out for.
Sure. I have one question. So far India has been lacking a pure play AI story, compared to, say, China, Korea as well. How much of a deterrent would that be for FIIs to once again look at India?
I think in the public equity markets, the basic premise in India remains that's what I mentioned, right? That there is a double-digit nominal GDP growth that gets converted into nominal revenues and eventually in profitability, and that gets reflected in the markets. And you can take any period, you will see a reasonably close link, which is not available in anywhere. So India is kind of a predictable way of allocating to India. And in that you have various sectors. So the Indian economy is fairly broad-based, and hence the Indian sectors are, and the Indian markets are reasonably broad-based in terms of opportunity that you can play. As compared to some other countries where tech or semiconductors or commodities become a very high chunk, and there is not enough diversification available. Whereas India gives it opportunity, and in the last 5-7 years at least, you've seen a lot many more new age companies getting listed from the private equity space. They're cashing out and they're listing. So the opportunity in the public equities has increased. So I think India has always been that play. India has never been a very high tech technology play, or or people expect Indian companies to be at the high beam of technology. I don't think India is seen from that perspective. So of course there have been articles about why India has not built a LLM model or those aspects. And those are relevant. There are structural reasons for it. Higher education in terms of research support in the universities. The ecosystem that other countries, including China, have built over the last 15-20 years in terms of high science, high research, and the funding ecosystem. If you see, most of the venture capital money that also comes to India and gets funded is predominantly on what you would call consumer tech or ed tech or fintech. It's not in high finance. Maybe space research is one place where you've seen some high tech money coming into finance. Semiconductor design could be one where, of course, it's not a new thing. The world is doing it, but maybe India might, in the next 5-7 years, catch up on that design story. But I don't think it's the expectations were never there in the first place that India will be in the highbrow of finance, of technology. So I don't think that is a big disappointment. It could be so in the private equity venture space because that's what is getting funded in the global market. That's why you're seeing maybe slowdown in that space in India, because India was mostly, as I said, consumer tech or fintech or ed tech as compared to high technology.
Got your point. Last question really, we've seen the kind of stupendous rally gold prices have seen. There's no arguing that equities have, of course, outperformed in the long run. But if you look at gold prices on the MCX, they have surged 45% in 2025. I think it's their biggest annual rally, so to say. The Nifty is up just 6-7%, YTD. Do you think hard assets is where the money is right now? What's your thesis when it comes to gold versus equities?
At Quantum, we've been since 2005, and actually we started the gold ETF. I started along with my colleague Chirag, the Quantum Gold ETF in 2008. And we've always said that every investor, every Indian investor especially, should have 5, 10, 15, 20% of the allocation to gold, depending on what your risk appetite is and how do you think about markets. And I always call gold as a hedge against stupidity. Like, there is central banks can be stupid, and government can be stupid, and policymakers can be stupid, and gold is a good barometer to see from that perspective. So whenever you see the stupidity quotient in the global markets going up in terms of activities of the central banks or the governments, you should expect gold to do well, and it is an hedge, right? So there will be periods where gold does nothing, and there will be periods where it gives you that hedge that you want for your equity portfolio. So if you have an equity portfolio, you should have like 10, 15, 20% allocation to gold, and that's a given. And in India, there's also an added thing that the rupee depreciates about 2-3% against the dollar. So that itself is a gold priced in USD and then in INR gives you that hedge against the rupee depreciation. And Indian, we don't need to teach Indians to buy gold. We will only have to educate them there to buy into a financial market as compared to buying gold physical jewelry. But whatever works for you, always have that 10, 15, 20% allocation to gold. And so that aspect. From a hard commodity, I mean, it becomes very cyclical to play hard commodities. It looks like some of the hard commodities plays are happening because investments in energy or investments in data centers or investments in semiconductor chips, and these aspects are reasonably commodities rich and commodity intensive, and you would see that play out whenever there are aspects of tariffs, or if you look at every country is now spending domestic capital and domestic incentive on domestic manufacturing or defense, right? These are the two aspects. And a lot of that will then have to do with materials and commodity. So you will see that, but as an investor to play it generally may be better to play it through companies and company stocks as compared to trying to play hard commodity. Because commodity futures, whatever I've understood and noted it's very difficult to play the rolling and the basis in the commodity futures. So it is better, I think, to play it through metals and other companies which get benefited when there is a price rally, but tends to be reasonably short term in nature because the supply response in the global world on commodities is very, very significant. So the moment you see price rises, supply increases from all sides. You see the price of oil, right? Oil and gas. It's been a flat for the last 10, 15.
Got your point. Arvind, lovely chatting with you. So many insights, and I wish we could continue this conversation, but we are running out of time. Would like to thank you for taking our time and joining in, and I wish to interact again sometime in the future.
Absolutely. Would love to come again and speak to you. Thank you so much.
Thank you. Thanks a lot. Well, on that note, take a look at the market. Not turning out to be a great Friday. Bulls are cooling their heels because now it's a 100-point cut on the index. We are below that 25,350 mark. Mid caps, however, are holding their heads above the water, but Sensex is now down almost 400, 82,637. That's where the Sensex is at. The advanced decline ratio still slightly in favor of gainers, even Stevens, so to say. And in terms of laggards, it's, I think, the FMCG names that are consumption FMCG names that are dominating the losers list, the likes of Nestle, Tata Consumer, Titan. These are among the laggards. Even some of the technology names, IT names, are under pressure. The likes of Infosys, HCL Tech, are under some bit of profit taking. Trend continues to see a downward move, but Adani Group stocks clearly the story of the day. All the Adani Group stocks are in fine fettle, with the likes of Adani Total rallying 10%. Enterprises Ports that are part of the Nifty are up some around 2 to 4%. All the other Adani Group stocks in the green, and of course some of the other NBFC names like Shriram Finance, Jio Finance are all in the green, and two-wheeler makers also not doing all that badly. Eicher Motors, Hero MotoCorp also holding out. But with that, completely out of time on this edition of Opening Bell. Of course, I'll see you at 12 p.m. With the management of Satvik Green. They are opening their the IPO, in fact, has opened up. The 900 crore rupee IPO will get you insight from the management as to what their growth plans are and what the expansion plans are going forward. So don't forget to tune in for that. But before I go, a message for our viewers. Introducing Money Control Super Pro, your ultimate investment superpower. Get live calls, trading and investment ideas from SEBI registered experts, pre-identified chart patterns and AI powered stock alerts on WhatsApp to help you trade and invest with confidence. Super Pro, where serious investors stay ahead. Download the Money Control app and subscribe to Super Pro today itself. Stay tuned to Money Control for all your other news and updates, and I'll see you soon. Thank you for watching.